it's the mechanics of that. So what you do is you get more money, and so that devalues the value of money. In other words, cash is trash.
You came on our air, I think, in Davos and said cash is trash. And you still believe it?
Of course you don't. Look, this is guaranteed.
Welcome back to Squawk Box. We are joined now by a very special guest right here at the SALT Conference in New York City. Bridgewater Associates founder Ray Dalio is with us. It's great to see you in person, I think, for the first time in a very long time.
We're coming out.
Right? We're coming out. We've all been trying to make sense this morning, as we do every morning, of where we are in this economy and where we are in the markets. And I haven't had an opportunity to hear from you and ask you where you think things stand right about now. I know you always think about things sort of in this in the machine, the economic machine. So help us understand what's going on inside Ray Dalio's mind right now.
Well, I think it depends on the time frame, and I think the relevant time frame is the next few years. And I think you have to put things in the context. So there are three big forces that have been at work, and I think you have to understand those. First is the debt money thing. How much debt and money, and what are the repercussions? How does that pass through the economy? What does that mean for markets, inflation, and so on? We're in a different era now. Zero interest rates, produce a lot of debt and monetize it. Second influence, the conflict, internal conflict over wealth, left-right conflict, that conflict. And then the third is the rising of a great power in the form of China, challenging an existing great power and challenging the existing world order. Those three things are coming together at the same time as then we have a pandemic. So I think each one of those is a cycle. What's happening now has not happened before in our lifetimes, but has happened in the 1930 to 45 period. I went back and studied it over 500 years. And so it's that context. So I think if we're talking about anything, we should look at that within that context.
Okay, let's break it down then, and let's start with the debt situation that we have in this country, and the zero interest rates. Given you're a student of history, what happens next?
There's not enough money to go around, right? We're spending a lot more than we're earning, and we have to do that partially because of this social redistribution, that necessity, and they can't take it all from taxes. And what that means is the printing of money. So it's the mechanics of that. So what you do is you get more money, and so that devalues the value of money. In other words, cash is trash.
You came on our air, I think, in Davos and said cash is trash. You still believe it?
Of course you don't. Look, this is guaranteed. You are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic, right?
So that suggests to me two things. Somewhat bullish, therefore, on the markets, I would think.
That's right. On the margin, so if we look at the expected return of equities, let's say U.S. equities and so on, and you do the projections of present value of discounted cash flows type of thing, you probably can have somewhere in the vicinity of 3.5 or 4% return, and you probably can get return relative to the return of cash, it's a better deal. But as equity prices go up, those excess returns go down. That's what produces more of a bubble. In other words, the lower returns there. And as that shrinks, and then if you should have rates to rise, that cushion narrows. And as that cushion narrows, you come into more and more danger zones. So that's what we're seeing happening.
Do you believe we're in an inflationary environment? And I say that because that seems to be the prevailing view right now. However, we talked to Kathy Wood on Monday. She said, you know what, actually next 5 years, deflationary because of technology.
Well, there's those are the pros and cons, right? So we're in an era where there's much greater inventiveness, and that's going to produce productivity if it's managed well in this politically challenging environment. But if it is converted into productivity, that is a deflationary force. But we're simultaneously in this world in which nobody is really going to get paid for those assets.
Right.
Okay, so you have to have the debt monetization. There's nothing that you can increase in supply quicker than money and credit. So let's look at it this way. There's a big increase in the value of financial assets. So think about yourself, each individual, and say how much of your net worth is in financial assets versus actual things, your house, your other things, your equity. And a lot of that money, there's too much of that money in financial assets that will never be able to get paid, because if you calculate how much is it in financial assets, and a financial asset is only a claim to buy goods and services, otherwise it's worthless.